Let's talk temporary rate buydowns. A temporary buydown lowers the interest rate for the first couple of years, initially making the payments smaller. The most common is a 2-1 buydown, where the rate is reduced by 2% in year one, 1% in year two, and then adjusts to the full rate and payment in year three. The buydown cost is exactly equal to the payment savings. It's not money lost, it's just paid up front instead of monthly. That's why sellers offer this as an incentive. Suppose a seller agrees to a credit towards the buyer's closing costs. If the closing costs are more than the seller's credit, it may make sense to skip the buydown and apply the entire credit towards the closing costs, leaving more money in the buyer's bank account after the close of escrow. Now, if the seller's credit exceeds the buyer's closing cost, the temporary buydown is a great option to use that up, since that extra credit must be applied towards closing costs or buydowns. It cannot be applied towards buyer's down payment. Here's a fact that sometimes gets misreported. Temporary rate buydowns do not help a buyer qualify for the loan. Lenders will underwrite using the full payment amount without the buydown. Temporary buydowns can be an excellent option for giving the buyer payment relief in the early years of the loan, but keep in mind that they are just a subsidy paid by the seller. Next week, we'll discuss permanent rate buydowns, how they work, the cost, and whether they're worth it. Have a great weekend.